Assalamu alaikum friends, welcome to lecture 4 of AFM. The topic is weighted average cost of capital, which is also known as WACC, the short form. This lecture is the most important lecture you can say. Okay, some lectures you see it's like you just 20% of your syllabus is only important. We'll give you 80% of the marks, right? This is one of that. Why? Because WACC is not just applicable for your section B, which is your investment appraisal. It is also applicable in your other sections of your syllabus. Like when you are going to do reconstruction later on, you need WACC. When you are going to do acquisition and merger, valuation of company, you need WACC. So you need WACC everywhere. Okay. And this lecture, this WACC topic, majority of it is on calculation. So you will see me doing lots of calculation throughout this lecture. It is not so much theory based, but we are going to study some bit of theory on it because you have to write something, but we are more focused on the calculation side of this topic. And this is most of it you must have covered in your financial management, which is good if you remember. If you do not, no worries, again we are going to revisit, and we are going to build up on more advanced things here, the WACC. But this is one of the topic, no doubt you're going to get a question on WACC. You have to calculate cost of capital. You have to be prepared for it. If you are not good in WACC, let me tell you, you are more likely to fail AFM. You are going to fail AFM if you are not thorough with this topic. This topic is one of the easiest topic also, but it includes lots of information that you need to read, lots of calculations you have to do. Okay, and you need to do calculations over and over again to become a pro in WACC. But this is one of the easiest. Okay, so, but we are going to go through the theory to do calculations, not because theory we are going to write. So you don't have to memorize anything here. And lots of formulas are going to be here in this topic, let me tell you. And most of it, good thing is, it's there in your formula sheet. So even if you do not memorize, it's okay. So let's start. What are we going to focus on this? We are going to focus on 4 areas. Number 1, the WACC, what it is made up of, right? Second, the cost of equity. Third, the cost of debt. See, the WACC is nothing, but it is made up of cost of equity, and you need equity and debt, right? Any company, how is it financed? You take equity from your shareholders. They use it, they reinvest their money. Okay, and the other one is either you go to bank, take loan, or in a bond. So there are two types of way you can finance a company: equity and debt. That's why when you calculate your cost of capital or WACC, anything, you can tell it, you need both equity and debt. But the way of calculating equity and debt are very different. This is very important. You need to pay clear attention to this. In the exam, you have to calculate this. No matter whatever questions you are doing, whether it's question number 1, whether it's question number 2, whether it's question number 3, any question can include this. Sometimes more than one question will have calculation of WACC. Okay. So I'm going to go a bit slow here. Okay. Cost of equity and cost of debt. And then we are going to study, can we use the WACC that is given when we are appraising a project as a discount rate? Sometimes we cannot use the WACC as a discount rate. Sometimes you can use. We'll see at the end. So let's start with WACC. Okay, this is just the summary of what we are going to go through in this lecture. WACC. WACC is made up of equity and debt. Okay, cost of equity. Now you need to know that cost of equity is calculated using it could be calculated in 3 different ways, and you need to know all the 3 different ways. But in your exam, you don't have to use all the 3. Out of the 3, one. And how do you know out of this 3 which one you have to use? It is based on the information that is given to you. You have to use your little common sense here. It is based on which type of information is given to you. Based on that, you have to choose the model. But when you are practicing at home, you need to know all the 3 methods. In exam, any one of it you might have to apply. First one is very common. You studied this in financial management, which is known as capital asset pricing model, CAPM. We are going to go in detail, don't worry. Then we have DVM, dividend valuation model. This also you have studied in financial management. Again, we are going to revisit. And the third is M plus M, Modigliani and the Miller's theory. 3 ways. Remember these 3 different ways. The way you can get the cost of equity using these 3 different methods are different. Okay. Next, cost of debt. Cost of debt, there are 3 types of debt. One is irredeemable debt. One is redeemable debt. And the third is credit spread. We are going to study what each of this means. Irredeemable debt. Okay, redeemable debt. Redeemable debt means it has a maturity date. It's going to mature at this date. That means for example, you took a loan for 4 years. So 4 years is your redemption period. That is a redeemable debt. Some, they do not have a time limit, unlimited. That is known as irredeemable. And credit spread is a thing which we use to calculate cost of debt. We'll go through that in detail later on. And WACC. When can WACC be used as a discount rate? These are the 3 areas we are going to cover. Cost of equity, cost of debt, WACC. So starting with WACC, this is the formula for WACC. It will be given to you in your formula sheet. Okay, but you need to understand what are the components, how it is made up of. Just seeing like this is not enough until you put numbers in it and calculate on your own. As you can see that before the plus sign we have VE divided by VE plus VD. That is the equity section. Then we have VD up. Same, denominator same, VE plus VD. That means value of equity and debt is always in the denominator, the total value. Out of it, what is the portion of equity plus what is the portion of debt? Into KE into KD. KE is cost of equity, KD is cost of debt. If you see on the right hand side, extreme right, you will see 1 minus T. Why? 1 minus T. T is what? T stands for tax rate. We'll see what each one means. Okay, I've already given it to you. VE and VD means value of equity and value of debt. E stands for equity, D is for debt. Market value of equity and debt. Sometimes they give you the market value. Most of the time you have to calculate the market value. For example, for equity, they will give you the share price. They will give you the number of shares. You have to calculate the market value. Just multiply the number of shares with the share price and you get it. Cost of value of debt also sometimes they might give you, or sometimes you might have to calculate. But when we do questions, we'll understand it better. But for WACC, you need value of equity and value of debt. That is VE and VD. Second is KE and KD. KE is cost of equity. How are we going to get it? In the previous slide, I have shown you the 3 methods. CAPM, DVM and KM plus M. KD, cost of debt. You have to work. Then T is the corporation tax, 1 minus tax rate. C, when we are finding the cost of debt, remember, debt is tax deductible. What is the meaning of it? Understand this very clearly. Whenever you are taking a debt, let's say you are taking a loan. On that loan, are you paying interest or not? Always you are paying interest. Interest is tax deductible. What does it mean? See, before you pay interest, before you pay tax from your cost, from your expenses, you deduct interest as a finance cost and then only you deduct tax. What does it mean? Deducting your interest from your expenses means what? Your expenses goes down. I mean, your profit, your expenses goes down, right? It is giving a tax advantage. Having an interest gives you a tax advantage. Why? Because when you are it's the other way around. When you are having an interest, your expenses goes up. When your expenses goes up, your profit goes down. That means you are now paying tax on a lower profit. So isn't it good, or is it good or bad? Paying tax on a lower profit is good because you have to pay less tax. But if you are paying tax on a more high income, you have to pay more tax. You can test this by yourself by doing a calculation. We have that question also. I think somewhere I have included that question. We are going to do it. What is the difference? Equity does not have. See, dividends, you do not pay before paying tax. Dividends after. So whether you pay dividend or not does not matter. You are not going to get any tax advantage. But paying interest, you are going to get a tax advantage because interest is deducted before tax. That means if you reduce your, if you include your interest as an expense, expenses goes up, profit goes down. Profit goes down means you are paying tax on a lower profit. That means your tax also will go down. Understood? If you're not able to visualize it, do practice yourself with some numbers. Put some random numbers and see for interest and tax and some profit and some expenses and see why it is good advantage is there. So debt has an advantage over equity that interest is tax deductible. That's why 1 minus tax. That means after tax. What is it? That is known as post tax also. You can say after tax, post tax. These are the terms that I used. KE is the cost of equity. KD, KD you cannot take cost of debt as it is. Whenever you take cost of debt, 1 minus tax. After tax you have to take. Always post tax cost of debt. Cost of equity, nothing to worry. Nothing to do with tax. Only cost of equity as it is. Next, now we are going to go to cost of equity. How do you calculate cost of equity? First, we are going to go through the three methods. We have introduced it: CAPM, dividend valuation model, and Modigliani and the Miller's proposition 2 formula. First, we are going to start with CAPM, our very common and famous, well-known CAPM. We all know that. What is the formula for this? The formula is this. This formula, I don't think it's given. It's not there in your formula sheet. This is an assumed knowledge from your financial management. So you have to know it. In case you forgot, learn this again. And always check. Go to your formula sheet today. You can go to any past paper and check what are the formulas that are there, because it doesn't change. Formulas, whatever is given in the past will always be given in the future also. They don't change every year. Just go and check what are the formulas that are given, what I need to learn. Okay. Don't rely everything till the last moment. That last moment only in the exam day only you're going to use that formula sheet and open up and see what formula is there, what formula is not there. No, do it before so that you become well prepared. Okay. So it is required return. That means RF plus beta. That B is known as beta into RM minus RF. What is it? RF is risk-free rate. This rate will be given to you. It could be a government bond and anything. It's given to you in the exam. All these things are given to you. You don't have to worry. Second is expected return. They sometimes expect, what is it? RM means expected return. They might not use RM. They might say expected return is this much. You should understand it is RM. Then RM minus RF, whatever is in that bracket, it is also known as equity risk premium. Sometimes they might just write a risk premium. So you do not deduct anything. Take that premium as it is and multiply it with the beta. But sometimes if they give RM and a risk-free rate separately, then that risk-free rate needs to be deducted from RM to get amount. And beta factor. See, beta factor measures your risk. Higher the beta factor, higher the risk. Lower the beta factor, lower the risk. That means according to the market, how risky is your shares. That is the meaning of, that's what beta measures. Okay, you don't have to know all this detail. You don't have to explain it. I'm just explaining you for you to understand what this beta is. That you have to multiply that beta with the RM minus RF and plus with risk-free rate. Okay, you will understand this better with calculations, questions. So don't worry. And beta factor will be given to you. Okay, but sometimes, okay, since this is a WACC questions, beta factor also you need to calculate. They might not give you as it is. Sometimes you have to find out that beta factor and then get the cost of equity most of the time. Okay, but when it's given to you, sometimes you have to do some adjustments. We'll see it at the later why. Sometimes beta factor, the way it is given as it is, you can take it, but there are some conditions applied. We'll see that. Then which beta factor to use? See, I told you which beta factor to use. Okay, normally current beta factor, whatever the feet is given. But what if the current beta is not given to you? You can use a proxy beta. Okay, and how do you get that proxy beta? Third bullet point answers that question. Proxy beta means you get a similar company to you. Maybe for your company beta is not given, but you see in the question they will give you a similar company. Do not ask me this question later on, ma'am. What if they do not give a similar company? No, there is no way. They will give you this for your company or that company, but they will give you. Otherwise, how are you going to find that beta factor? Without beta factor, you cannot proceed on. You cannot go ahead. Okay, and they will give you a proxy beta. Proxy beta means a beta for a similar company, similar quoted company. Why quoted company? Why not unquoted? See, beta factors are publicly available for what companies? Quoted companies only. Unquoted companies will not have published beta. It is only for quoted company where you can get the proxy beta easily. Okay, similar company to you. Business has to be similar. How do you understand business similar or not? How will you understand in the exam? They will tell you. Don't worry. They will tell you this business in a similar line of this business. Sometimes part of it is similar to your business. Other part might be different. Sometimes the whole business is similar to you. Don't worry at all. If you're not understanding, if it's too early for you, do not worry. We are going to solve this also through a question. Because I told you this lecture is only purely based on questions. The reason we are studying this theory is to go to do our calculations. We are not going to write all this thankfully you don't have to sit and write all this theory. Okay, but if I immediately start doing questions, calculations, you will not understand anything. Why this beta factor? Why did we take this? Why did we take that number? So to understand that, this theory needs to be explained first. Once you understood this theory, once you know how to do calculations very comfortably, forget about the theory part. You are you have reached that stage. But until that, you have to keep these notes with you. So similar business means in terms of risk, they are similar to you. That time you can use their beta. Okay. But again, there is a problem. They might be similar in some aspect, but not in every aspect. There will be differences in that company and your company. So is it appropriate that exactly you are taking that proxy beta, that beta only for your company, and you will adjust? No, you have to do some adjustments with that beta before you can use it in your company. Okay. So it needs to reflect, see, any beta value for any company needs to reflect these two things. It has two things there. Number one, it is known as business risk. That means how risky is your business. It is measured in that beta. Through that beta value, you can tell. The second is financial risk. That means the level of your gearing. That means what is your portion of equity to debt. Obviously, we know when debt is more, it's more risky. What is your gearing ratio? So two types of risk is there, which is both are measured in that beta value. And you know, every company has different business risk, different finance. Their gearing is different. No two companies will have same gearing. Even if they have gearing, the same business risk might be different. If business risk is same, financial risk is different. Sometimes both are different. Understood? So that's why we need to do some adjustments. From this, we arrived that there are two types of beta. One is known as asset beta. The other one is known as equity beta. Understand the difference very clearly. I'm going a little slow here because this is very, 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 very important. Without this, I will tell you not to even go to the next lecture also. Don't proceed in financial AF. Don't even think about going to AFM exam if you're not pro in this. I'm telling you this from before. This is the most important. This is one of the 90% of your marks you are going to get from this. Understanding of just beta factor, the WACC. One is known as asset, which is ungeared. Ungeared means what? It only measures business risk. Ungeared, no debt equity, 100% equity. Second is known as equity or geared beta. No, both the terms. Sometimes they might not give you asset beta. They might write ungeared beta. But most of the time they write asset beta. Sometimes they write equity beta. Or sometimes they might just write geared beta. So sometimes students get confused. They write geared beta for asset, ungeared for equity. That's why know both the terms. I have highlighted it bold for you. Write it somewhere. Asset ungeared, equity geared, asset ungeared, equity geared. Do keep repeating this to yourself until you know this one is for this one is for this. And the way the symbol will be beta A for asset, beta E for equity. So E stands for equity, A stands for asset. It's very easy to understand it in that way. Okay. So know that asset beta only business risk. When it's equity, it measures financial risk as well. It includes both business and financial risk. Geared means what? Equity plus debt. So it includes both. So now tell me, before I start a question, we have a test to understanding one. Now we are finished with this. We are finished with capital asset pricing model. That's it for this. We are going to go to the next model, that is dividend valuation model. But before going to that, we are going to do a question on CAPM. But before doing this question, also let me ask you this question. Now tell me, just this is very common sense. Which beta will be higher? But this you need to understand in your question also. Which beta will be higher? Is it asset beta in terms of number I'm telling you, or equity beta? It is the equity beta. Exactly. It is the equity beta that needs to be higher than asset beta always. Mark this. We are going to see this in questions also. I'm going to tell you how you know whether you are correct or wrong. Because you have to calculate both. Okay. Equity beta will always be higher than asset beta. Why? Because it's very simple. Asset beta includes only, it's ungeared, no? Only equity, only business risk. But equity has both business risk plus financial risk. So definitely your equity beta will be higher. Now let us do a question to completely finalize this, finish this off, capital asset pricing model. How to calculate equity beta based on CAPM before we go to the next model. One more thing I have forgot to tell you before I go to the next question is that in the exam you will often have to de-gear the proxy equity beta. What is the meaning of de-gear? One is known as re-gear, one is de-gear. See, when you are using the equity beta, proxy equity beta from a similar company, okay, they will have different asset beta, equity beta. Their gearing will be different, their business risk might be different. De-gear. Remove De-gear means remove their business risk and equity risk from that equity beta, and when you bring it to your company, put your equity beta, like adjust with your gearing ratio there. That is known as re-gear. And then the equity beta that you get, that is the one you have to use. Don't worry if you're not understanding this also. Through the question, I will show you. It's always better to illustrate through an example rather than just tell de-gear, re-gear. Don't memorize it like this. AFM is all about application. That's a fun part about AFM that you can always test. Okay, now which beta factor to use? The formula to re-gear and de-gear, which I forgot to tell you before I start the question. This is the formula. This formula, you through the same formula, you can de-gear also, you can re-gear also. First you need to de-gear, then you need to re-gear. If you see, it is asset beta is equals to value of equity divided by value of equity plus debt. If you see near to debt, always 1 minus t, you will see always 1 minus x next to d into equity beta. Same way you can find equity. This is for asset beta. You can find for equity beta also. Just change the subject. Bring the equity beta other side, take the asset beta the other side, and find out. This also I will show you through questions. Okay. So let's do the question. So here we are, test your understanding 1. The directors of Mole and Company, which has 75% of its operation in the retail sector and 25% in manufacturing. See, I have told you, sometimes they will give you portion. That portion of this is in this sector, other portion is in this sector. Sometimes the whole entire industry is in one sector. Okay. If it's in one sector, it's easier. But if it's in two different sector, you need to do two separate cost of equity, asset beta and equity beta unit. So they are trying to derive the firm's cost of equity. However, since the company is not listed, it has been difficult to determine an appropriate beta factor. Instead, the following information has been researched. So they have given information for retail as well as manufacturing industry. Retail industry says quoted retailers have an average equity beta of 1.2. They have also given you the gearing ratio 20-80. 20 is debt, 80 is equity. Okay. Manufacturing 1.5 is the equity beta. They have given equity beta. Please, not asset beta. Gearing ratio is 45 to 50. 45 is debt, equity is 55. Risk-free rate 3%, equity risk premium 6%, tax is 30%, gearing is 50%, debt is 50%. But for Mole and Company, this 20-80 and 45-55 debt is for what? It is for which company? It is for the retail industry separately and manufacturing industry separately they have given. But for entire industry, gearing is 50-50. Assume that risk on corporate debt is negligible. Calculate the cost of equity using the CAPM model. They will not even tell you this also in the exam. They will just give you information and you have to identify. Out of the three methods, which dividend valuation you cannot use because you are not given the growth rate, you are not even given the dividends. Then third is M plus M. That also you cannot use. You need geared and ungeared equity for that. The only thing is cost of equity. See, the minute you are given risk-free rate and a risk premium, this is the hint. The minute you are given this two information means you have to use CAPM model. I repeat, the minute you are given the risk-free rate and the risk premium, you know it is CAPM model. Easiest way for you to identify. Most of the time it is CAPM model only, but that does not mean the other two methods we don't have to study. How do you start this type of question? I'm going to go slow here because this is your starting. Once you set your starting strong, you'll be able to do other questions like within seconds. What do you need to find out? What do you need? Equity beta is given to you. Can you use that equity beta? Can you use? No. Because you are an unquoted company, unquoted. You're not listed. But the equity beta, proxy beta that you are taking is what? From the quoted. So some business risk is different, their finances risk because gearing is different. How? You have to adjust. So what do you do? Always. Okay, I will tell you this. Start with asset beta. You always need to start with asset beta. Sometimes they even give you the asset beta. You need to find the equity beta using that. But most of the time, asset beta you only have to calculate. That's the whole point. This is the real challenge. Second, I will tell you the steps first, then we'll do the calculation. Then, using asset beta, you need asset beta. That's why this step you need to get it very correctly. And that is the longest step. You get this correct, the rest is just use the formula and get it. Then using asset beta, calculate equity beta. Once you get equity beta also, using equity beta, put it using beta, put it in CAPM model. Remember, you need a beta factor in CAPM model. This is that equity beta that you needed in capital asset pricing model. That's why we are doing all this. Use it in CAPM to find what? Find cost of equity. That's it. You need this cost of equity only in the WACC calculation, isn't it? These are the three steps. The rest two are easy. Step 2 and 3 because they are just using the formula. But first one you need to do working. Okay. So here you are given two industry. Separately you have to find for the two industries. So let's start with the retail industry. Okay. So retail industry, what information are you given? You need to find the asset beta of the retail industry. What are we finding in the asset industry? The asset beta. This is the starting point. Get this straight away. For any question, you might after this try to do questions similar to this. So what is the formula? Always write the formula. You don't have to write the formula now because it is on a CB platform. Earlier it was in a manual, this thing we had to write the formula. But thank God. But you have to use the formula in Excel, okay? You have to use Excel for this. Of course, you can use Word. There's no doubt. But using Excel is always better in calculation. Okay? What is the formula? I will first write the formula. It's given there in your formula sheet. The asset beta formula. Asset beta equal to equity beta multiply by value of equity divide by, sorry, not the whole thing. Maybe I will rub it. Only this part. value of equity, E will come up, okay? Value of equity will always come up, E. Then again, whatever you write here will go down like this, plus value of D. E plus D in the denominator and 1 minus tax because it's debt. This will remain. This is the formula. Now put the number. Are you given the, you are given the equity beta, but for what? Retail industry. What is the equity beta? 1.2. So this 1.2 I'm going to use it here. 1.20 multiply by what is the value of the equity? That means equity, portion of equity is 80-20, right? 20 is debt, 80 is equity. So 80 divided by, again 80 plus 20, 1 minus tax. 1 minus tax means 1 minus 0.3 because 30% is the tax, that means 0.3. When you calculate this part separately, multiply this with 1.2 and get the answer. Okay, and when you are doing this down part, okay, I will show separately rather than going it in one stroke. 1.20 multiply by 80 divide by, when you are doing it, are you doing 80 plus 20 into 0.7 or 20 into 0.7 plus 80? How are you doing it? You have to first multiply 20 into 0.7. That will give you 14. See, you should always first multiply that 20 by this before you add with 80. That's how it should be. That means this 1.20 into 80 over 94. Then now you can do anything. 1.2 into 80 divided by 94. What will be the answer? 1.02. Is it 1.02? Are you getting? It's 1.02. Correct. So don't, okay, let me tell you the mistakes that students do. Don't do this. They do 80 plus 20, okay, like this. 80 over 80 plus 20 is 100 into 0.7. That because 1 minus 0.3 is 0.7, which will give you what? 80 divided by 100 into 0.7 is how much? 70. You see, this number becomes even bigger than the denominator. How can it be? Numerator becomes bigger than the denominator. Can it be? No way. Because you are, so this is wrong. Don't add. First, always multiply your debt with the tax. Then you add with equity. Wrong. Don't do this. And there is, even if you go it that way and get the cost of equity, cost of asset also, sorry, asset beta also, let me write this, asset beta also, you still will get the wrong answer. You still will know whether you have made a mistake or not. Very easy to check, which most of your textbook also will not tell you. This is not given in the textbook. This is, I'm telling you, this is what I have learned from my lecturer, which I'm telling you. This is the reason why you always need a good lecturer. A good lecture is always valuable over self-study. I always tell that. But no worries. You still have online those things to tell. Like you have me, so that I can tell you from the thing. As I told you, asset beta is always less than equity beta. So just check. This is 1.02. Asset beta. What is your equity beta given to you? 1.20. 1.20. Check. 1.02 is less than 1.20. This is asset beta. This is equity beta. So technically, maybe number wise you might be wrong, but usually it's not. When you're technically right, number wise also you're right, because that's how you got the calculation. This is right. Correct. It fits well with our what we have explained. Asset beta will always be okay. Asset beta, or the other way also you can write equity beta will be more than asset. Asset beta will always be less than equity beta. Write this star mark. If you know those things, you can never go wrong, because you will always check what you have calculated is less than what you have got or not, given to you or not. So this is correct. 1.0 is less than 1.2. So this is right. Why? Because I told you asset beta includes only business risk. So it should be less. Equity beta includes both the asset and equity, business and financial risk. So 1.20. Okay. This I will highlight it. I will keep this answer somewhere. Sorry, keep this in the box so that later I can use it. Now using that 1.02, you need it. Hold it. It's not over, guys. We have manufacturing industry. Equity retail is okay. Similar way, what we have done for retail formula used for manufacturing. Okay. So I'm not going to write the formula again. Once or twice when you do the formula right, you automatically know the formula. It's by 100. That's why I always tell you do as many questions as possible in this area. It's always beneficial for you. It's not time consuming. What is equity beta? 1.45 this time. Manufacturing is 1.45. Please go up and check into. What is the equity debt? Equity is 55. 55 plus 45, 1 minus 0.3. Tax remains the same. Do the calculation similar way to this. At the end, you have to get this answer 0.92. You have to get this. If you are getting any different answer, that means you are wrong in the way you have calculated. Maybe you have added before multiplication, or your BOTMAS is wrong. Okay, you cannot be. So 0.92. Is there any way to check? Yes. Again, this is less than 1.45. Asset beta is less than equity beta. Correct. So now this also I will put it in a blue box. Both the asset beta you got. Now what do you need? You have both the asset beta, but you need the total asset beta. The asset beta that you have is separately, one for manufacturing, one for retail. You need the whole, one asset beta only you need for the whole industry. You understand? How do you get that? Just use the weighted average of this two. That is the asset beta of molded. Because one asset beta only you need for one equity beta. You cannot have two. So use weighted average. That means you know the proportion of equity and debt for mole, and what is the proportion of this is given in the very beginning. If you see 75% in retail, 25% in manufacturing. Using this proportion 75 and 25, now you have the two asset beta, multiply it with the proportion, get it one asset beta. This is how you work out when you have two. Sometimes you might have three also, but they will not give you three. Usually it's two or one. So 75% into asset beta of what? Retail, plus this is maths, 25% is into multiply by asset beta of this blue thing only we are using. This is one also for the retail. This is from manufacturing, which is how much? 1 in this case. Usually it's not 1. In this case it's entirely purely 1. This 75-25 has to make up 100%. Okay. Now you have got the asset beta. Now what? One asset beta you have got. Now what I told you, step 2 is what? Equity beta. Use this asset beta to find equity beta. Which formula? Which formula? Same formula that you have got the asset beta, but change the subject. Make equity beta the subject this time, because the formula is set in such a way that asset beta is the subject. Okay, I will show you. Oh, it is asset beta equal to value of E plus value of D into 1 minus tax. This is 1 minus tax into equity beta. So you need to make this the subject of the equation. Now this has to come on the equal side, because on the equal side is what? Asset beta. You need equity beta. Already this is given to you. So what do? Just bring this entire side on this side, because this you cannot bring the other side. If you bring it to the other side, it becomes negative. Understood? Rather bring the value of equity over value of equity plus value of debt 1 minus tax on the other side. So how it changes? This is division on this side. Once you bring it other side, it becomes multiplication. So asset beta multiply by VD plus VD into 1 minus tax, divide by VE. Now you see what's happening. Reciprocal change. Denominator becomes numerator, numerator becomes denominator when you bring it the other side. That's it. That's it. That is only small change from asset to equity beta when you want to change. That's it. Using the same formula only, no two different formulas. So now use asset beta is given to you. What is it? 1. So that means it will not change anything. 1 multiplied by. So what is the value of equity this time? Remember, now you know the entire business. 50-50. That whatever the proportion of equity debt was given separately for retail and manufacturing, not applicable anymore for the entire industry. 50-50. So 50 equity plus 50 debt, 1 minus tax, 1 minus 0.3, divide by 50, multiply by 1. Just do 50 into 0.7 plus 50, divide by 50. Your equity beta at the end should be what? 1.69. Is this correct or not? Is this correct or not? Definitely it's correct, because equity beta is more than asset beta. Asset beta is 1. This is 1.69. That means this has to be more than 1. Now this is also, now you have got equity beta, asset beta 1, 1 equity beta. Now what? Just use it in a CAPM formula and get the cost of equity. You might get confused. Equity beta, cost of equity, they are two separate things, okay? First it's cost of equity, sorry, first is equity beta, then only comes cost of equity through CAPM. So the third step, CAPM, okay, red color. Risk-free rate is given to you. Okay, I will write the formula. KE. Risk-free rate plus beta into RM minus RF. Okay, in this case, risk-free rate is 3% plus beta. Just now you have got 1.69. This 1.69 you have to use here. Multiply by, they give you the risk premium or separately the market return minus risk-free. They have given you 6% as risk premium. So do not go and do 6 minus 3. No. Risk premium means already they have deducted risk-free rate from the market return and got that risk premium. So you just multiply by 6%. Once you get it, how do you do that? First multiplication, then comes addition. Remember, 1.69 into 6 plus 3, not 3 plus 1.69 into 6. If you are bad in your botmas, I cannot help you in that you have to work out on your own. I can only teach you the method in AFM how to calculate using the formula. So that you have to do. Okay, which will be 13.1%. This is your cost of equity. That's it. So now let us go to the second model. Dividend valuation model. Now, this model is based on assumption that the value of the company or the value of the share is what? Simply the present value of what your expected dividends will be in the future. That means whatever dividends you expect in the future, you discount it, and that is your value of company or share. Right? See, because we are talking about dividends or shares, because we are talking about equity holders, right? What is the cost of equity? Basically, what will be the return to the equity holders will be the cost, the return versus the risk, because the cost measures the risk, how risky the equity is. So your return will be, whatever your risk is will be your return. Higher the risk, higher the return. So that's how it goes. That's why we are studying this model. Okay. But in this model, one additional thing is there. It's not just the growth, it's just not the present value of the expected future dividend. Also, that dividend has a chance of growing. You do not get same times of dividend, right? It grows. So a growth rate is assumed here. Even though in reality, this assumption does not work, but for this model, we'll go it like that. Okay. For your exam purpose, we'll go by this assumption. So we assume that there's a constant growth rate in dividend, which is known as G. Now this is a formula. That is D0, that means year 0 dividend into 1 minus G, 1 plus the growth rate, divided by KE, that is cost of equity minus growth rate. Okay, if we need to derive the KE, what do we need? We need that KE. That's what we need. Just change the formula. Make KE the subject and this becomes the formula. Dividend of year 0 into 1 plus D, that means 1 plus the growth. Always 1 plus the growth, divide by the share price plus growth rate. Okay, this also you will understand through calculation. So I will show you there. Now, illustration of this formula. Let's go through this question. Let's say dividend is 14 cents per share, growth is 3%, share price is 1.48. If you go by that formula, it will be 14 for cents means 0.14 by the way. 0.14 into the growth. 1 plus growth rate is what? 3%. So 1.03. 1 plus 3%. Divide by the share price. After that again you plus 3%, just the growth rate. 3%, not 1.03, just 3%, 0.03. We are using the formula only, which will give you 12.7%. So your cost of equity is 12.7%. Now, there are two ways you can estimate the growth rate. We have told that growth rate we have to assume, but for estimating that growth rate also there are two ways. And both the ways you have to know. In the exam, out of this two you have to use one, depending on the information given to you again. First method is known as you based on the past. You decide, you assume the dividend. Second is formula is given. That means whatever you're going to retain in the business, level of earnings retained in the business, you assume that growth is dependent on that reinvestment, whatever is retained. So this is the formula. If you want to go by the first method, that is you assume dividend growth by the past. That means you need the past year's dividend for this. That means for past 3 years dividend might be given, past 5 years dividend might be given. You see sometimes number of different years are given, and on that different years dividends are given. First year this is the dividend, second year this is the dividend, third year this is the dividend, fourth year you find out what is the growth. From first year to third year how much it has growth. This is the method to find it. Formula. G, growth rate. Square root of D0 plus dividend of n years ago minus 1. C, it is your oldest dividend. Sorry, newest dividend, newest. D0 is newest, latest dividend divided by your oldest dividend. That means, let's say from 2001 to 2005 you have been given dividend. That means 2005's dividend divided by 2001's dividend. Okay, take the square root of it. Or the other way is, if you're not comfortable in using the square root, n square root, use D0, that is newest dividend divided by oldest dividend to the power 1 divided by n. 1 divided by 1 is fixed, n is number of years. 4 years, 3 years, for how many years? Minus 1. Okay, this also through calculations, we have calculations for each of those, don't worry. Second is retention model, earnings, how much earnings you have retained. That is another name is, this formulas are there in your formula sheet. The model is known as Gordon's growth model. This is the formula. Okay, you need two things for that. One is R, one is B. So G, that means growth is R into B. You need two things. One is R, one is B. What is R? R is the retention rate. How much earnings you have retained. They will give you 70%, 30%, 40%. This will be given to you. Sometimes be very careful, guys. They can trick you. They might not give you retention rate, but they might give you how much dividend is paid. They might say 30% dividend is paid. What does it mean? If 30% dividend is made, means what? The balance is retained. So 70%. Sometimes directly they will not give you this much dividend. They will tell you in terms of dividends paid. So the balance is retention rate. Second is R. B is retention rate. R is what? R is not retention rate. B is retention rate. R is what? Rate of return to equity. What is your rate of return to equity? They will give you this also. They will give you both the variables for you to find the G. Because it's not possible for you to find G if only one variable is given. Next. KE should be used, which will be derived using CAPM. How are you going to use the cost of equity? That means here we told, right? KE, rate of return to equity. This rate of return to equity, how are you going to get it? Through CAPM only. So that means for dividend valuation model, you have some part of CAPM you must have used, right? That cost of equity, you will get it from capital asset pricing model. Here we are only worried about, this is only used in when we are predicting growth. Okay. So now let us do a small question using dividend valuation model when we want to find growth. So in this question, you have to estimate the annual growth rate in dividends. Dividend has been 32 cents 5 years ago. Now it is 20 cents. Sorry, 5 years ago the dividend was 20 cents. Now they have 32 cents. So you have been given the time, you have been given the two different dividends now versus 5 years ago, and you have to estimate the annual growth rate. So now let's do that using the formula. What is the 5 years ago dividend? It is 20. Okay, so that means 5 years ago dividend, the oldest dividend multiplied by the growth rate, right? To the power how many years? 5 years. Has to be equal to 32, because whatever the growth rate has been over the 5 years, you multiply it by the oldest dividend, that is 5 years ago's dividend should be equal to today's dividend. That's how it has to come to 32, right? So now you can easily find out the g. Just make g the subject. So 1 plus g to the power 5, keep it this side, 32 divided by 20. Bring 20 the other side, multiplication becomes division. This is your maths, pure maths you have to know. Leaving 1 plus g on one side, 32 divided by 20, okay, to the power 1 over 5. Because this 5, when you bring it to the other side, just make it the reciprocal, 1 over 5. Or the other way is, it could be like this, 32 over 20. But this is a little bit complicated to put, rather putting it in fraction is easier. Okay, so g, keep it this side, 32 divided by 20 to the power 1 over 5 minus 1. Now you can easily get the g, which is 0.1. That means 10%. Okay, so 10% is the growth rate. Now, how do you know whether this 10% growth rate is correct or not? Just put that 10% in this growth rate here and check, are you getting 32 or not? Very simple. So that's it. Now we are going to go to the third, that is Modigliani and the Miller's model. Now we are moving to the third method to find cost of equity from our capital asset pricing model to our dividend valuation model. Now to the M plus M. This theory is also known as M plus M, or Modigliani and the Miller's proposition 2 formula. This is the formula. It is given in a formula sheet. Okay. So K, VE and VD we know. They are the market values of equity and debt. Then we have KD, that is pre-tax. Remember, it's before tax. KD. You have to multiply it with 1 minus tax. Then we have T. T is the tax rate. KEI. There are two types of this one. One is KE or KEI. Over up you will see is I. KEI is cost of equity in an ungeared form. That means just equity, no debt. KE, just KE is the cost of equity in a geared form. That means it has both equity and debt. That's what we want to find out in a geared form. So that means to find the cost of equity in a geared form, you should be given the cost of equity in an ungeared form, because then only you can use this formula to find it. Sometimes you might be given the cost of equity in the ungeared form to find geared form. Okay. Sometimes this is not for this stage. It is in the next lecture that I'm going to discuss about, that is the adjusted present value. Okay. There you might need KEI, cost of equity in an ungeared form. So you will be given the cost of equity in a geared form, and using that you have to find KEI. But for now, we are not worried about it. It is for the next lecture. That also you need this formula. So now let us do a question on this before we move on to cost of debt. That's it for cost of equity. Test your understanding too. Here we are going to find the cost of equity using the M plus M theory. So the company is with 20/80 debt equity ratio. That means 20 is debt, 80 is equity, and already they have used this and they have got 12% as cost of equity. Now, see, whenever they have told using this, they have got this cost of equity. Do not again recalculate to find out this correct or not. You cannot do it also because you're not given the risk-free rate and all those things. Tax is 30%, gearing is 25 to 75, 25 debt, 75 equity, and expected return to debt holders is 4% per year. Okay. Now you have to use the Modigliani and the Miller's theory, that model. So first, as I always begin, that you start doing by the formula KE, that is KEI plus 1 minus tax into KEI minus KD, value of D divided by value of E. Now, aren't you given the cost of equity already? You have been given the cost of equity as 12%. But is it cost of geared equity in a geared or ungeared? It's geared. Geared. Why? How do you know? Because they have told already that using a 20/80 debt equity ratio, they have got this 12%. That means it cannot be ungeared. It's geared. Geared means debt equity both. Ungeared means only equity. That means this time already they have got this 12%. You don't have to find out. You have to find ungeared. Okay, plus 1 minus tax rate is 30%. KEI, you don't know. Minus KD, cost of debt. What is cost of debt? 4%. This is the cost of debt. Whatever is the return to the debt holders, this is your cost of debt, which means 0.04. Value of debt over value of equity. What is value of debt? 20/80. 20 over 80. So now 0.12 equals to KEI plus 0.7 because 1 minus tax into KEI minus 0.04. 20 over 80 will be what? 0.25. I'm doing this step by step. 0.12 equals to KEI plus, okay, see, you can multiply this and this 0.7 and this easily, isn't it? So 0.7 into 0.25 will be 0.175. Put it in bracket so that it becomes easier. K, this you can keep it, bring it down, minus 0.04. Now 0.12 KEI plus, multiply, do like this and multiply like this is maths, multiply the outside bracket with the inside bracket, so it will be 0.175 KEI minus, we are basically opening the bracket, so 0.175 into 0.04, use calculator, it will be 0.007. Now this is 1, okay, this KE and this is 0.175, so 1 plus 0.175 will be 1.175 KEI minus 0.007. Bring the 0.007 the other side and add with 0.12, it becomes 0.127 equals to 1.175 KE. If you just want this, just simply divide 0.127 by 1.175 equals to KEI, and your KEI will be equal to what? 0.108. That means 10.8%. Okay. Is it enough? There is another way of checking this also, whether this is correct or not. See, this 10.8% should be less than 12%, because this is ungeared. This is geared. 12% which is given to you cost of equity using CAPM should be more than what you will be getting using M&M tier, that is ungeared 10.8. Now you have to re-gear. Remember de-gear and re-gear? This process, all the steps what you have been doing here, okay, what is it? It is de-gear. You have been de-gearing it, removing the effect of this thing, just equity. Now using your debt equity ratio, you are going to re-gear. So now you have to find the cost of equity, KE. Okay, you first find out this 10.8%. Using this you will find KE now. Okay, so what is your KEI? Using the formula 10.8% plus 1 minus tax 30% into 10.08% minus, this is ungeared, this is your debt. Everything else remains same. What changes? This ratio changes. Value of equity and debt changes. It becomes 25/75. Earlier it was 20/80. You see, this changes. Because of this change, you have to do this again. So now your KEE will be 12.4%. It increased from 12 to 12.4% because this changed. Debt equity changed. So that's it. Now we can move on to the cost of debt. The cost of debt. In your exam question, you sometimes will be given this, sometimes you have to calculate this. And when you have to calculate this, remember it is always pre-tax. Okay, if it's given to you, it's pre-tax. Before tax they give you, you have to adjust it for tax because you always want after tax cost of debt. Then it can be assumed that cost of debt will mean pre-tax cost of debt unless it is stated clearly otherwise. Yes, if they do not say anything about the debt, whether it's pre-tax or post-tax, you assume it is pre-tax only, before tax. But if they specifically tell you this is post-tax, it has been adjusted for tax, then you do not adjust it for tax again. Okay, most of the time what I have seen based on my experience, the tax that they give, sorry, the cost of debt that they give you is before tax. You have to adjust it for tax. Okay, as you know why we have to adjust it for tax, I think now you know, because of interest, which is which will helps to reduce your tax. I mean, interest you deduct, I mean it increases your expense increases means profit goes down. Now you're charging tax on a lower profit, that means your tax will go down. Now there are two types of debt that you should know. One is known as irredeemable debt, the other one is known as redeemable debt. Okay, when it is irredeemable debt, it is simply your cost of debt into 1 minus tax. Okay, I is what you will get your interest. I is your interest paid. Tax is your T is your corporation, and M is your current bond price. What is this bond price and all? In this cost of debt, there are many types of debt we know. Long-term debt, short-term debt. We went through all those in the previous lecture. Islamic finance, then we had short-term loans, leases, long-term loan, bond, debenture, all we went through. But mostly for the calculation of debt, what we are going to discover more is your bond, valuation of bond. Okay, loans and all is okay, it's fine. You just take the interest and all, but it's bond that we are going to worry about. Okay, so market value of bond. This also will do test understanding 3 now to understand this, how to calculate irredeemable bond. The next is a redeemable bond. Redeemable bond means you have a fixed time that by this time you have to pay it. You're going to get your interest as well as the principal amount. Redemption period is given. Wherever period is not given, nothing has been mentioned about the year, which year this is going to be redeemed, it's an irredeemable debt. But in the exam, they can give you both the types, or just irredeemable or just redeemable. But most of the time, what I have seen, redeemable debt has been asked because it is more calculations to do compared to irredeemable. Okay, but anyway, learn both. So let's do test your understanding 3. Test your understanding 3. So this is irredeemable. They have already mentioned it. You have to find the post-tax cost of debt. Tax rate is 30%, 5% coupon bond, and trading at 94.5 per $100. This terms you need to understand it very specifically. This is for bond, that's why. And bond, you will see in AFM, you will at least get one question on bond. Sometimes more than one also, but bond valuation will always be there in AFM. Okay, especially under debt, you cannot skip it. So you have to know what is this coupon bond, face value, per value, all these terms you need to understand. What is this 5% bond? 5% is what? Your debt. That's why they have given you. So how are you going to find post-tax? 5% is pre-tax, 1 minus tax. Tax is 30%. Okay. And what is the formula? This is irredeemable. So you multiply the cost of debt, that is 5% into 1 minus tax, and you divide this by the market value of the bond. That is the formula for irredeemable debt. What is the market value of the bond? 94.5 per 100. So it's 94.5. It is the value. So you divide by 94.5. And what is the after tax? It is 3.7%. It will be less than this 5%. Your cost of debt will be less than your pre-tax debt. Remember this. It cannot be more than, so the moment you exit 5%, more than 5%, you know you are wrong. Somewhere you are wrong. That means more than your coupon bond. Coupon bond is the cost of debt, pre-tax cost of debt, 5%, right? If it's more than 5%, you know you're wrong somewhere. This is the way to check. This is 3.7%, because then what's the advantage? You're at the main reason you are using debt is what? Why we say interest is tax deductible, so that it reduces your cost of debt. And just now we have seen that having interest, that is having debt, and because it is tax deductible, it will reduce your cost of debt. So it's 3.7% now. Now let us go through redeemable types of debt, and then we'll do a question. Redeemable debt. Okay, redeemable debt, you can use your IRR to find out. Internal rate of return, it is known as. Okay, internal rate of return of what? See, when we have already went through IRR and net present value in the first lecture, this time we are going, when we are calculating bond valuation, the cost of debt for the bond, that is the cost of debt for redeemable debt, right? But IRR using what? Number one, bond price, interest, which is net of tax, obviously you have reduced it after tax, and redemption payment. Good thing is, in your ACCA website, there's a technical article which covers this bond valuation, bond yield. Please go and read it. It's a must. I advise you, because it shows how you calculate the bond yields and all, which is very important for your exam purpose also. Now let us do a question on redeemable debt, test understanding 4, before we move on to the credit spread. Test your understanding 4. Here also you have to calculate the post-tax cost of debt. Okay, so you have been given the 6% coupon bond, which is priced 89%. Bond are redeemable at par in 5 years, and corporation tax is 30%. They will always tell you it's redeemable at such time. If it's not, it's an irredeemable debt. Simple. Now you have to calculate IRR. You have to make use of your IRR knowledge here to get it. That means we discount at what? Two rates. That's how you see, to calculate IRR, you always need two figure, two discount rates you always need, whether it is net present value, whether it is bond valuation, but you need two discount rates. So we need what? Two rates to discount. Okay, that is called as interpolation. We are using interpolation basically. So already one interest rate is what? What is the discount rate we are discounting at? See, this is at 6%. Okay, at 6%, what is the price that you are getting? You are getting 89%, right? Isn't it? So if you use a discount rate, okay, you can use a discount rate that is more or less than this. One discount rate you can use more than this coupon. Okay, one you can use less than this. That means, let's say you can use 5% and 10%. Let's say one is more than 6%, more than coupon rate, the other one is really less than the coupon rate. Okay, so present value at 5% and present value at 10%. Okay, so at 5%, the present value will be what? See, already you have been given at 6%, that is 89%. Currently priced at 89%. Okay, so equal to, that means 6% you cannot use. Okay, so 89, here also 89, minus minus. What is that coupon? 6%. That means you are paying interest at 6%. So 6. But this interest is tax deductible, 1 minus 30%. Same for here. I know it's a little confusing, but there's no other way. Into for both 5-year, 5% annuity factor. See, this is for 5 years because all the 5 years you have to pay interest, isn't it? So interest every year is same. That means you can use annuity factor, 5% annuity factor, 5 years annuity factor. Here also you can use 5 years annuity factor. Just a minute, guys. Okay, so 5-year annuity factor, but the percentage that you're using is different. Here it's 5%, here it is 10%. Okay. The whole thing needs to be minus. It's a long calculation, but what to do with this is AFM. 100 into 5-year 5%. That means 5-year 5%. This is C. Why 100? Into 5% discount rate. 100 into the 5th year's 5% discount rate. This is not annuity factor. This is discount rate. Why? Same here. 100 into 5 years 10% discount rate. This is not annuity factor. This amount is the principal amount. That means only for the 5th year, whatever the discount rate at 5% or 10%, you are just multiplying it by the 100. That means that 100 you are finding the present value, the 5th years, because principal amount at the end only you will get, you will give, right? You will repay back the principal amount. That is 100. 100 is the principal amount. Okay, whereas 6 is the interest. Total is 106. But 6 you have been paying in 4 years. Okay, even this 4 years, when you're discounting, you'll be using 5 years only, annuity factor. The final year, the 5th, sorry, I'm sorry, I'm confusing you. Interest, all the 5 years you have to pay, but the principal amount in the 5th year you are paying along with the interest. That's why you are finding the discount rate. Okay. So now, that's how you find out. From 89, you first deduct the interest, present value of interest, and the annuity factor. For both present value at 5 and 10%. The amount that you get, okay, this has to be equal to minus 7.58. This has to be equal to 10.98. One is positive, one is negative if you see. Okay. So now use IRR. What is IRR? Low interest rate, that is 5%, plus the present value in the lower interest rate is negative, over negative interest rates, that means the low interest rates present value, that is minus 7.58 minus 10.9, the higher one. Okay, into 10% minus 5%, the difference between the two interest rate. This is how you do normally IRR, but in terms of present value, net present value, you are using the present value of the bond at 5% and 10%. Then you will be getting 7.04%. This, you see, it will be between 10 and 5% only. It has to be between this 2%, 5 and 10%. So this is the post-tax cost of debt, 7.04%. Okay, make sure that you understand this. Now we are going to go through the credit spread. What is this credit spread? And why do we use it? We need it to calculate the cost of debt. See, a risk-free rate you will be given in the question. Credit spread also you will be given. You just have to use this formula to find it. So your risk-free rate plus your credit spread, whatever you will be given in the table, that you have to minus it by tax or minus tax. That is your post-tax cost of debt. Usually this credit spread means it's like a credit score that is given to you by some credit agency, credit risk agency. These are agencies that gives a companies some credit scores based on how you pay or how well are you paying them, or are you delaying so much, are you able to pay back on time. If you are getting a good score, that means your credit spread, that means you're less risky, right? But if you're more risky, you'll be getting not so good score, you'll be getting a bad score. It could be in terms of grades, like they have triple A, double A, triple B. This are scores that they give ranks. If it's triple A, that means it's the best, the risk is the lowest. Okay, and this is how it is presented. The credit spread comes in a table like this, and this table will be given to you in the exam if you have to make use of this table. If there is any use, particular use, then only they will provide this table. So the moment they give you this table in the exam, you have to know that definitely you have to make use of this table. That's why that table is given to you. If it's not given, don't worry, because without this table you cannot get the score. So as you can see, the ratings AAA, AA, A, triple B, double B, B plus. These are the ratings that are given by different agencies. There are so many agencies are there, right? So AAA, that's the best. As long as it goes up, it's good. If it goes the other way down, from AAA to AA, that means it's becoming worse and worse, right? Credit ratings are falling down. Sometimes it happens. You will get a question where the ratings change, then how do you perform calculations? And you have it for this fixed years 1, 2, 3, 5, 7, 10, 30 years. Sometimes you'll be having year which is not there. Like they might ask you what is the credit rating for the 12th year. 12 is not there. But still you can find out 12. How? Using 10 and 30 years, because it is between 10 and 30. Like that. So for example, let's say triple A rating for the first year is 5.5. You can see as long as the years increases, I'm only taking triple A, rating increases 5, 10, 15, 22, 20. Why? Because as long as the year increases, okay, the bond becomes more and more risky. And when it becomes more and more risky, the credit spread is more. That's how you decide. Credit spread is more means it's more risky. C for B plus. Compare first year only. Triple A versus B plus. Triple A is 5, B plus is 375. That shows how risky B plus is. That's why the credit spread is so much. When you check for the 30 year, B plus 450, that is the highest, most riskiest. So now let's do questions. We have plenty of questions on credit spread. We are going to do this question where you have been given the credit spread. We have two questions. One is known as simple illustration. The other one is advanced illustration. In the simple illustration, you have been given the 5-year treasury bond. The return is 3.6%. You have been given a C company has equivalent bond in issue as an A rating. What is the expected yield on the C's bond? So what are you supposed to do? Simply just add this with the credit rating from the table, 3.6% plus the A rating for 5-year. Okay. So you need to go to the table, go to the rating first, go to 5-year first, and 65, and this is known as basis point. Okay, 65 basis point. So when are you writing 65? Do not write 65, but it is in terms of percentage. That means it will be 0.65, right, percent. So it will be equal to sorry, 4.25%. This is the answer. That's it. Now you will always be given this return, okay, to add with the credit spread. You just have to add the credit spread with the return. That's it. Now let us go to more advanced illustration. Same. This is 8-year, 4.2%. Okay, here it is triple B rating. The issue here it's for 8 years. You are not given 8 years. You are given 7 years and 10 years. 8 years falls in between, right? But you can use 7 and 10 year. Which one? Triple B. Because the rating is triple B, right? If I'm not mistaken, yes. How do you do this? So you need to use the ratings of 7-year, which is 126, and 10-year, which is 149. Okay, this is how you need to do. Start with the 126 and 149. Okay, I will write here 114. This is 7-year, this is 10-year, 8-year in between. So when you are doing it, start with the lowest always, 126. This is the method, fixed method, plus, and formula is not given. Find the difference between the 2 years. 149, the oldest, the highest minus the lowest. 149 minus 126. It should be positive. Okay, that means 10-year credit spread minus the 7-year credit spread. The difference you find out. Divide by what? Divide by 3. Why? Because 10-year minus 7-year. Difference is 3 years, no? So you add 126 plus 7.67, which will give you 133.67. So this is the rating, credit spread. That is not your answer. You have treasury bond return 4.2%. Okay, so 133.67, this is in terms of percentage. Sorry, this is basis point. Basis point means when you have to find it in terms of percentage, just divide the credit spread by 100, which will give you 1.34%. And the answer is 5.54%. You see? Now let us go to test your understanding 5. Test your understanding 5. The current 4-year risk-free return is 2.6% and it is at AA rating. A. Calculate the expected yield. B. Post-tax cost of debt and corporation tax is 30%. You have to use a credit spread. I have not copy pasted it here, but make sure that when you are doing this question, you have the credit spread in front of you. Okay. So here also 4-year, you don't have for 4-year in the table. Okay. You have for 3 and the 5-year. 5-year and 3-year. So same. For 3-year, it is 30 plus, this is the credit spread 30 from the table you will get for the bond. What is the rating? For AA rating. Just go to the AA and for 3 years, it's 30. For 5-year, it is 37 minus 3 year. This divide by, what is the difference between 5 and 3? Year 5 and year 3 is 2. So the answer is 33.5. Remember, this 33.5 is the basis point. Okay, you have been already given the risk-free rate, which is 2.6%. And when you have to find this 33.35, that is in terms of percentage, you have to find out, because this is percentage. You cannot come and plus 33.5 here. Okay, please don't make that mistake. So it will be 0.0335%, which will be equal to 2.935%. But this is pre-tax. It has not been adjusted for tax. Adjust this for tax now, after tax. Just simply multiply it by 1 minus 0.3, because 30% is the tax. That means multiply by 0.7, in other words, which will be 2.05%. Do you see the cost of debt coming down? This is only possible because of tax. Interest is tax deductible. Now we are moving on to test your understanding 6. Landline company has a A credit rating. It has 30 million of 2 years bond in issue, which has a trading at 90%, and 50 million of 10-year bond with a trading 108%. Risk-free rate is 2.5%. Corporation tax is 30%. Post-tax cost of debt capital. Looks a bit too much, right? Here there are 2 bonds, if you can identify. One is 10-year bond. Other one is 2-year bond. Now tell me, can you add both these bonds and then calculate? No. They are trading at different prices. They have a different maturity period. One is 2 years, one is 10-year period. Whenever there are more than one bond in a question, it is possible. You cannot add both. Both bond needs to be done separately. That's what you need to understand. First, start with the 2-year bond. Okay. Later you can add, but first when you're calculating, calculate separately both. So first is the 2-year bond. Okay, for this 2-year bond, what do you need? To find the cost of debt, remember you need 2 things. Market value and KD. KD is cost of debt. These are the 2 things you need for the bond. What is the market value of 2-year bond? Are you given it or you have to calculate it? Calculate it. What is the bond? See, you have been given that it has 30 million and it is trading at 90%. Just multiply 30 into 90%, 0.9, which is $27 million. This is the market value. Now find the cost of debt. What is the cost of debt? They have already given you. Risk-free rate is 2.5%. Okay, this is for both 2 years and 10 years. Okay, and corporation rate is also same for both the bonds. This is only the market value which will change. So 2.5%. What is the spread? If you go from the table, please make sure you have the table. What do you have to use? For 2 years, for what is the rating? A. You will have it in the table. It will be 50 credit spread. 50 credit spread means 0.5%. 50 divided by 100. Always basis point divide by 100. That's how you get it in terms of percentage. 50 means 50 divided by 100. That means 0.5 basis point. Sorry, 0.5 percentage. Because this you need it in percentage to add with this risk-free rate. Otherwise, you cannot take 50 and add with 2.5. It will be 52.5%. Not possible. So it will give you 3%. 3% is the cost of debt. Keep it aside, okay? This 27 million and 3% keep it. Later you need it. Now same way you do for 10-year bond. This should be easier now. Market value. It is 50 million trading at 108%. So 1.08, which will give you 54 million. Cost of debt will be risk-free rate is same 2.5% only, but your this will change from 2 to 10 year when you are going with A rating. 75 basis point means 0.75. If you see your cost of debt will be higher now than 2 years, 3.25%. Now overall cost of debt, because you have two types of bond. Bond can be any types. Even you can get a loan also with this bond. That is also possible. 3-4 types of debt you can get. So you have to find the weighted average cost of debt. Okay, to find the weighted average cost of debt, remember, you need the ratio. You need the ratio. How do you get the ratio? How do you get the ratio? See here, the weighted average cost of debt. Okay, just wait a minute. You need that proportion. What proportion is 2%? Sorry, 2-year bond, and the other one is 10-year bond. So here, the weighted average cost of debt, given that the ratio of the market value. Okay, so they have already given this ratio, okay, which they were not given in the question, but it is here in the answer when you see the market value. If you go with the market value, it is 1:2. That means one is for 2 year. This is for the 10-year bond. Okay, this is how you need to go. So that means when you are calculating 1/3, 1 plus 2, 1/3, the total. This is for the 2-year bond. What is the cost of debt? 3%. Okay, you can take it and then add 2/3 because 2/3 is for the 10-year bond. 10-year bond, the cost of debt is 3.25%. Already you have calculated this and this. Finally, 1 minus tax, 30%, which is 2.22%. You can add both the debt and then you deduct tax finally because both are tax deductible, right? When you're taking debt, add both 2-year and the 10-year bond and then deduct the tax. Multiply 1 minus 0.3 with it, the whole thing, right? This market value they have already given. Oh, yes, sorry. This market value 1:2, I was just calculating it. They did not give it. You have to calculate it based on market value. How? See, market value after you have got, not before, not this 30, 27, based on the size 27 and 54. Okay, so when you're taking it, how are you taking it? 27 plus 54 is how much? 81. Take 27 of whole 81, it will give you 1/3. This is how you know that 1/3. That means 1/3 is for this, the remaining 2/3 is for the 10-year bond. Okay, sometimes they will not give you the ratio. This is how you need to calculate that ratio. What portion of is for 2-year bond, what portion is for the 10-year bond, based on the market value. You have to get that ratio. Market value after you have got, not what 30 and 50 that what they have given. No, the market value that you have calculated it. Based on that, you have to get the ratio. It's very important. So now that's it. We'll go to test your understanding 7. Test your understanding 7. Here you have been given 3 separate year, and the government bond, the yield curve for government bond is separate for 3 different years. Why is it? Earlier we just went through one risk free which we added with the credit spread. Now why 3? Because when the year increases the bond, the risk free cannot remain same. That also changes in reality. Okay, this is more practical. So every year if you see, it increases from 3.5 to 3.65, then to 3.8, because it becomes more and more riskier. So that risk needs to be there even if it's a government bond. And you have been given the credit ratings with 3 different years, 1, 2, 3, with the credit spread. Now the question is, estimate the individual yield curve for stone company and A rated company. Okay, so when you do that, first you need to put this in 3 separate year. Okay, that means just in this table only I'm going to do it. 3.5, 3.65, 3.8. So first year, this is which rating? A rating. A rated means only this 3 you need. Okay, 46, 60 and 70. So just add. It will be 0.46, it will be 0.6 and it will be 0.76 basis point you have to add. Just add this both columns and you will get here in this column the answer. What is it? 3.96, 4.25 and 4.56. You can see as the year increases, the yield increases more. Why? It becomes more and more risky. That's the reason. Now let us do test your understanding 8. In this question, you have been given 3 bond A, bond B, bond C with 3 different coupon rates and different redemption period. So under this, you are supposed to calculate the spot yield curve. Okay. For that, you have to discount each bond's cash flow. Okay, this is the whole process. And the par value is 100 for all the three bonds. Okay, bond A redeemable in 1 year, bond B redeemable in 2 year, bond C redeemable in 3 year. Coupon rate for bond A 7%, 6%, 5%. And this is trading at 103, 102, 98. Okay, so you can see two bond A and bond B are trading above par. Par is 100, one is 103, 102. Bond C is trading below 100. That means it is trading at a discount. The bond A and bond B are trading at premium. How do you know? When something is above par value, it is at premium. When something is below that, it's trading at discount. Okay. Now you need to calculate how to do this. And this type of question has been asked in the past paper, by the way. So you have to know that. But do you know the discount factor? That's the whole point. No, you don't. But that's what you are asked to find. Basically, you are asked to find the R, the discount rate, the rate. That is your annual small yield curve. Annual spot rate means for all the 3 years you have to find. Year 1 will be different, year 2 will be different, year 3 will be different. Okay. So you start with bond A. Okay. Bond A is the easiest. So bond A, what is bond A? It is trading at 103. Correct? And at a coupon of 7%, that means 100 par value plus the 7%, so 107. This 107 you need to discount by what? By what? 1 plus r to the power 1 because it is year 1. You have to start with bond A because bond A is in 1 year's time. Once you find this r, you can use this for this, and then once you find for this, you can find for the third year. That's how you go. Bond A, bond B, bond C. Okay, because it is for 1 year, it's easy to start like this. Okay, so can you find R1 like this? Just make R1 the subject and find the R1 first, because if you do not find R1, you cannot use it, find bond B. So R1 will be equal to, keep 107 the way it is, take 1 plus R to the other side and bring 103 this side, so it becomes a division. Okay, and plus 1 becomes minus 1. So your R will be equal to, I'm writing it in terms of percentage directly, okay, 3.88%. Now answers always in box I put so that you become easy. Bond B. Bond B, it is 102. Okay, but see, this was 103 only. Why? 3 is your interest. Sorry, I'm sorry. This was 107 because 7 is your coupon rate. That is your interest plus 100. So 107 and is only for 1 year. That means in that 1 year only you are paying the interest as well as the principal amount. Nothing to worry. Second year when you come, 2 years you are paying. So first year just the interest. That means just the coupon rate. That is 6%. Second year you are paying 6% plus 100, 106. So 6 and 106. Okay. And 102 is the market value. So just keep it aside. So this time you are going to pay 6%. But you know the discount factor for the first year. So you can easily discount. What is it? It is just 3.88%. That means 1 plus the discount rate. So 1.0388. That's why you need this R1 first for bond B. Use that R1. Plus, when you go to the second year, it is 6 and 100. So 106 divide by 1 plus R to the power 2. That's, sorry, R2. You can just use R2 but to the power 2 because this for the second year you have to discount. But you don't know R2. But you can find. Just make R2 the subject. How do you do that? See, this calculation you can directly do. Okay, just R2. I'm going a little slow because some of you might not be able to make R2 the subject. Some of you will be able to do it. So I don't want to skip that part and go because I don't want you to later on struggle and ask me the same question. So I will show you here. You need to follow closely. 106. Keep as it is. Just take this, the other side, this side. So 106 remains the way it is. Okay. Rest. Bring 100 to this side. You see, this side is going this side is going that side. So the sign changes. 102. It becomes a division now. So minus this you can easily do. 6 divided by 1.0338. Okay. 5.78. How do you know that this minus this? Just okay. So this becomes, and then you have to take the square root of this, or you can say 1 to the power 2. It's the same thing. Minus 1, because you need to find the square root of r, which will be 4.96%. Okay. Oh, okay. I will show you another way of doing this. I think this is a little quick. Keep this side. Rather bring this 6 divided by 1.033 the other side. So 102 minus 5.78. Okay. Equal to 106 divided by 1 plus r2 to the power 2. Okay. This becomes like this now. So this, because this is to the power 2, you want to remove this square. Once you want to remove this square, you have to make this the square root, because this to the power 2 becomes the square root when you bring it to the other side. So square root of 102 minus 5.78 equals to 106 divided by 1 plus r2 only. Okay. Once it has become like this, 1 plus r2 bring to the other side. This becomes this side. So 1 plus r2 equal to 106. This becomes a division now. Reciprocal, just change. Square root of 102 minus 5.78. R2 remains this side, just bring 1 the other side, it becomes minus 1. That's how you get R2. I hope I am not so fast. Okay. So now R2 also you got 4.96%. Now use bond C. This will be a little complicated because it has 3 years. So 3 years you have to pay. What is the interest? Coupon rate? To find the interest coupon rate, 5%. 505. Okay. But it is trading at what? 98. The $98 equal to 5. First year when you have to discount that, you have already R1, that is 1.0388. Keep this aside. Plus second year also you have 5. 1.0496. Just now you have got to the power 2. Third year, this is known as interactive process. Okay, it will be 5 and 105 divided by 1 plus r3. You don't know what is r3 to the power 3. You have to make this the subject in this long equation. So this and this you can automatically find out the number. Okay, so add both. Okay, so it will be 98 equal to 5 divided by 1.038 is what? 4.81 plus 5 divided by 1.0, what is it? 4.54 plus 105 divided by 1 plus r3 to the power 3. This you don't know, but this both you can bring the other side. Okay, it becomes 98 minus 4.81 minus 4.54. This is to the power 3. This becomes cube root 3, or let's say the whole thing 1 to the power 3. So R3 becomes, if you bring it this side, this whole thing comes down below 105. So it will be 105 divided by 98 minus 4.81 minus 4.54 to the power 1 over 3 minus 1. Everything is minus 1. That is your R3, which is 5.8%. You will automatically see this percentage going up. First it was how much? Wait, just first it was 3.88. Okay, now list all the 3 percentages that you have got. R1, R2, R3. R1, R2, R3. 3.88%, 4.96%, 5.8%. What can you see? As your year increases, percentage increases. What yield will increase? Definitely, because it is becoming more and more riskier. Bond is becoming more and more riskier. So amount will increase. If it goes the other way around, from 3.8 to 3, then 2.8, you know definitely somewhere something is wrong. It should always go up, it cannot go down. Something is wrong. This is how you check. So now, what else? Let's go to the next question. Test your understanding 8. In this question, we are going to calculate WACC. That means all your understanding. This is the final question in this lecture under WACC. So, regarding all what you have studied in your cost of equity, cost of debt, now you need the understanding to calculate WACC using both the knowledge. Okay. So, let us first read the question. An entity has the following information in its balance sheet. You have been given ordinary shares 50 cents nominal, 2,500, that means 2.5 million. Debt 8% redeemable in 5 years, 1,000. Entity's equity beta is 1.25. Credit rating is A. Share price is 1.22. Debenture price is 110 per 100 nominal. Now you have been given that credit spread table. You have been given risk-free rate as 6%, equity risk premium 8%, taxes 30%, calculate WACC. Everything is given. This question needs to be very simple for you, but it requires a lot of working. Okay, and you need to know where to start from. Okay, what is the formula for WACC? First, let me write that down for you. WACC is, first we'll start with value of equity over market value of equity plus market value of debt into cost of equity plus market value of debt over market value of equity plus market value of debt. Okay, but in debt one more thing is there. This into cost of debt, but this needs to be minus 1 minus tax, needs to be adjusted for tax. Now let us do. First find cost of equity, then find cost of debt. You can do it in any order, but equity usually requires more working than debt. In this case, which method are you going to use? We went through 3 methods to find cost of equity. What are they? Capital asset pricing model, dividend valuation model, and Montague and the Miller's theory. Can we use CAPM? Definitely, I told you risk-free rate is given, risk premium is given. It is the hint that you have to use CAPM. Equity beta is given. Can we use dividend valuation model? No. You have not been given anything about growth rate. Nothing has been mentioned about dividend. Can we use Montague and the Miller's theory? No. You are not given anything regarding ungeared cost of equity. So the only choice is CAPM. Through this, you are going to find cost of equity. Okay. But the question is, can we use the cost of equity that they have given, or you need to find it out? That's the question. In this case, yes. Why? Because you are not using any proxy. Just see, are you using any proxy company or anything? saying that this is the, you have not been mentioned anything about the proxy company. If nothing has been mentioned, you cannot do de-gearing, re-gearing. See, this is the problem. When you study so much, you tend to think that you have to make use of it. Somehow you try to make use of it. I know most of the students, even in this question, they will try to re-gear, de-gear, thinking equity. They always doubt, that nothing is given straightforward. This equity beta you cannot use. No, that's not the thing. Nothing has been mentioned about the proxy company's activity. They have this debt, they have this equity, this is the gearing. No, if nothing has been mentioned, just use the equity beta given as it is. Simple, 1.25. In this case, you can use it, 1.25 as it is. But you need to find the market value of equity. That's what you need to work out. The VE. Okay. So what is your VE? See, first you need to find the number of shares. Okay. You see from your balance sheet, this is 50 cents nominal, 2,500. So first, what do you do? VE 2005, write the whole amount. When you're working out, never write 2005. Don't drop down the three zeros and do. Write down. You have your Excel, you can write down the whole number. Divide this by 0.5, 50 cents. Multiply this by the share price. What is the share price? 1.22. This is the share price. For each share is 1.22. So 1.22. So what is the amount that you are getting? $6.1 million. Keep this aside. Cost of equity. Now, what is KE? Just use your CAPM model. Right? What is your risk-free rate? 6% plus. Already equity beta is given as 1.25 into what? Into 8%. Just risk premium only. No need to minus 8 minus 6. No. See, how do you know when you have to minus the risk-free rate? Only when they give market return. This is risk premium. Already they have deducted the 6% and from something and they have got 18%. It's like 14 minus 6 is 8%. So just multiply by 8%. When you do it, first multiply, then add. BOTMOS, please apply BOTMOS. 1.25 into 8 plus 6. That shall give you 16%. Right? 0.16, so 16%. So you have this on your checklist. Now you need to go to cost of debt. Cost of debt, you need two things, market value of debt and cost of debt. So cost of debt, you can easily find out. How? Your risk-free rate plus your credit spread and just adjust it for tax. What is your risk-free rate? It is 6%, isn't it? It is what? 6%. Simply. Same risk-free rate. What you have used for CAPM, you can use here also. Plus credit spread. What credit spread? You have to see 8%, 5 years. The rating is A rating. So A rating, 5 year, 65 basis point. 65 is a basis point. So 65 basis point means 0.65%. So it will be 6.65%. But remember, the 6.65% is pre-tax, adjusted for tax. 1 minus tax. Tax is 30%. 1 minus 30 is 70, so 0.7. Which will be 4.66%. Obviously, if you see this is 16 and this is 4.66%, your debt will be less, cost of debt will be less than your cost of equity. Now, find the value of D. Value of D, when you have to find out, just check, it's 1 million. Okay, 110 per 100. That means for 1, you have to find out what is the amount of the 1. So it will be 110 divided by 100 multiplied by 1 million. 605. Okay, it will be 1.1 million. This also, so this also you got, this also you got. Do you have all the four components in your hand? Value of equity, cost of equity, value of debt, cost of debt. Have all the values? Go ahead and calculate. Put it. What is VE? What is VE? 6.1. What is VE plus VD? That means 6.1 plus 1.1. This. It will be 7.2. Multiply by cost of equity 16%. Plus, what is the value of debt? 1.1. Total will be 7.2 only. Equity and debt. Multiply by cost of debt is 4.6%. 66%. Multiply this by 70% because after tax. Total will be 14.3%. This is your WACC. If you see your WACC, it will be less than your cost of equity, but more than your cost of debt. It will be in between your cost of equity and debt. That's the whole point. You're putting that debt there so to reduce your WACC. Otherwise, your WACC will be cost of equity 16%. Okay. Now we are going to go to the application of duration. Application of duration to debt. Debt you have duration you have already covered. Macalo duration and modified duration in investment project. We saw that. Now we are going to use it here also in the bond valuation. Okay, so this method, what do it tells us about the debt? That means your bond. The duration tells us that it measures the sensitivity of a bond's price to a change in interest rate. See, will have an interest rate, right? Definitely, it's a debt. It will have an interest rate. That means when a bond price changes, how much your interest will change? How sensitive is it? That means if an interest rate changes by a small amount, 3 to 5%, how much the bond price will change? How sensitive it is? If the change is very much, okay, that means it's not very sensitive because it's not possible that a big amount of change will happen in a short amount of time. But if the change is very small, that means it's very sensitive, that even a small change in interest rate can have a change in bond price. We'll see that. But this is just a brief introduction to it. We are going in detail to it. Third that you need to understand is bigger the duration, greater the risk associated with the bond. You should know this. Bigger duration is not good. You have to avoid it. So now let us do a small question on this. Applying duration to the debt. So in this question, we are going to see the calculation for a bond. How we are going to calculate duration for the calculation of a bond. Sorry, duration calculation for a bond. The company has 10% coupon bond. They are redeemable at par in 5 years, trading at 97.25%. Pre-tax cost of debt is 10.743%. Okay, so what should you calculate first? First, Macalo duration is calculated. Okay, there are 3 steps. Step 1. What do? If you can recall your memory of Macalo duration that we have explained in investment appraisal, that is my lecture 1, you will be able to identify step 1 here because it's the same step. You need to calculate the present value of each future receipt from the bond. Using what discount rate? This discount rate, the pre-tax cost of debt. You do not use post-tax, you use the pre-tax cost of debt as a discount rate. Because to find present value, you have to find the discount rate also. Okay, so you do time 1, time 2, time 3, time 4, time 5, and the receipt. And the present value at 10.743%. What is the receipt? 10% coupon bond. So first year 10, second year 10, third year 10, fourth year 10, fifth year 10 plus 100, 110. When you discount, you will be getting 9.03, 8.15, See, this discount, you cannot use the table, discount factor table. You need to discount. Do you know how to discount, by the way? If you don't know, let me show you. First here, if you want to discount this 10, it will be 10 divided by 10.743. Okay, 1 plus 10.743% to the power 1. Second year, it will be 10, 1 plus 10.743% to the power 2. That's how you get, make sure you get this figure. That's how you get it. Okay, this is in terms of percentage. So put it in terms of decimal and add with 1. And don't forget the powers to the power 1, 2, 3, 4, 5. Okay, so that's how you find the present value. I've just showed you the manual way because Excel will be able to do it, but yeah, you need to know the manual way as well as using the table. 7.36, 6.66, 66. If you see the last year, it will be more because it has a principal amount also there. Now, this is step 2. Step 1. Step 2, calculate the sum. Okay, sum. That means time to maturity multiplied by present value of receipt. That's why we first found the present value of receipt in step 1, because you needed to multiply with the time. So 1, that means just the year. First year, present value is 9.03. Second year, 2 into 8.15. Third year, 3, 7.36. Fourth year, 4, 6.66. And the fifth year, 5 multiplied by 66.05. Just add all. That's why it's the sum of all. 404.30. Here we are just taking the receipt, okay? Nothing to do with outflow, investment and all. How we take for net present value. That's why we are not taking year 0. Most of you might later ask me that question. That's why I'm answering you here right now. Just the present value of inflow. Then we have step 3. What is step 3? Divide the total present value of receipt that you have just got. Okay? Divide this by the total present value of the receipt. That means the bond price. You have to divide this by the bond price. So what is the price? 404.30 divided by, what is it? Trading at 97.25%. So you have to divide it by 97.25 equal to 4.157 years. This is Macaulay's duration. So you will get it in terms of years. Longer the duration, the more the volatile the bond is, riskier the bond becomes. Now, that is about Macaulay's duration. What about modified duration? This comes after Macaulay's duration. Okay? It is what? It is just simply the Macaulay's duration divided by 1 plus the discount rate. So what is the Macaulay's duration? 4.157 divided by discount rate. Discount rate is 10.743. Okay, percent. So it will be 110743, which will be 3.754. Now you have got both. Explain what it means, what this modified duration means. That means it identifies how much the value of the bond will change if there's a change in interest rate. That means the value of the bond will change by this number of times, 3.754 times, if an interest rate changes. Right? Now, let us go to the benefits and the limitations of duration. Benefits of modified duration. The number one benefit is that no matter whatever the maturity dates of the bond, even if the coupon rates are different, you still can compare the two bonds from the duration. So because of this, this makes the decision making process very easier. Second advantage is that if the portfolio of bond, okay, is constructed based on weighted average duration, it is possible to identify the change in value of the portfolio as interest rate changes. That means what would be the change in the value of the portfolio when interest rate changes? It's very easy. Third is it reduces the interest rate risk. How? You can just easily change the duration of the bond portfolio. For example, by adding shorter maturity bonds to reduce duration. If you want to reduce your duration, just add shorter maturity bonds rather than having longer maturity bonds, which will reduce your interest rate risk also. Now, coming to the limitations, number one limitation is this relationship, that it's a straight relationship between changes in interest rate with the change in the bond value, right? They assume it's a linear relationship, straight line relationship, which is just an approximation. It's not, it's just an assumption, which is not true. Okay. In fact, the relationship between the interest rate and the bond price is like a form of a curve. It's non-linear. Okay. It's like it is convex to the origin. I will show you the diagram a little bit later. So the more convex the relationship is, you cannot make decision based on duration. It becomes very inaccurate to measure the interest rate sensitivity. Third is, it is just a reasonable estimation, not the accurate estimation, that if the change, what will be the change in the value of the bond or the loan due to change in interest rate. Okay. When interest rate changes are small, yes, you can use duration easily. But when interest rate changes are big, this becomes difficult to measure, to use duration to measure the interest rate sensitivity. Now, let us go in depth what is this convexity a little bit more so that you understand. See, whether the bond price will be sensitive to the change in interest rate, it depends on their redemption date. Are they going to redeem early or later? Why? Because when bonds are redeemed over a long period of time, it is more price sensitive to interest rate. Over a long period of time, interest rate changes more, right? There are changes in interest rate will change. Let's say 10 years versus 3 years bond. Over the 3 years, interest rate change will not happen so much. But over 10 years, it is. So that's why when bonds are redeemed at a later date, they are more price sensitive to interest rate changes. That means they are more riskier. Okay. So what does duration do? It measures the average time. That means the average time it takes the bond to pay its coupon and the principal. That means the interest and the principal. Coupon means for the bond it's coupon and the principal amount. So what does it say? Higher coupon will mature sooner. Higher the coupon, that means more interest. You are going to mature the bond very soon. Compared with lower coupons. Lower coupons will take more. The duration will be long. Why? Because their redemption dates are long. This is because a higher proportion of higher coupon income is received sooner. So if you are receiving higher income sooner, your bond are less sensitive to interest rate changes and will have a lower duration. Duration will be low if you're having a higher coupon bond because bonds are less sensitive to interest rate changes during their short period of time. It's like it's better to receive higher amount of coupon earlier than later because later interest rate changes will affect the bond price. You understanding? Now, duration can be used to assess that change in value of a bond when interest rate changes using the following formula. What is this? The triangle P means change. Triangle stands for change. Okay, change in P, change in price. Minus D. What is D? Duration. It's a negative. Into I. I is the redemption yield. Okay, P is the price of the bond because you want to know the change in the price of the bond. D is the duration. I is the redemption yield. This is the diagram what we're talking about. Okay, and this formula is not there in your formula sheet. You need to memorize it. Okay. Usually when this question comes, they do not give a calculation here. This is more like explanation theory. For your discussion, you need this. And trust me, in the past they have asked a question on this. You will see in a revision kit questions also. Question, I think around, I don't remember the marks, but 5 to 6 marks has been asked on this question. Theory part, the discussion part. Why duration is not useful to measure interest rate sensitivity, or why do you think it's useful? Then you have to mention this convex relationship and nonlinear. This relationship you have to explain. You don't have to explain through diagram, but you have to explain it by writing. But this diagram is there for you to understand, visualize it better. Okay. What happens? What's happening in the diagram? First, we'll go by that straight line. That's the relationship that is predicted, right, by duration. It says higher the interest rate. You see, it is going on the right side, means interest rate is increasing. Higher the interest rate, bond value is going down. Correct, no? Higher the interest rate, bond value will go down. Opposite relationship. But actual relationship is not like that. It will go down up to a point, again it will start increasing. The interest rate increases, bond value goes up. It's a convex relationship. The more that convex, that curved line is away from the straight line, the more difficult it becomes for you to measure the interest rate sensitivity through duration. That's the whole idea. Okay, that's what you need to understand. That's it, nothing much. So duration can be used only when interest rate changes are small, not for big change. It cannot measure. Why? Because if the change is very big, it will change the shape of the yield curve. That's why. Until the interest rate does not change the shape of the yield curve, yes, you can use duration. Otherwise, you cannot. This is, you have to write. Okay, all these things you have to write in your theory part. Discussion part you need to write. That's why I've included this point. But if the shape of the yield curve changes, duration cannot assess the change in the bond value due to interest rate changes. That's what you need to write. So it has its limitations, basically benefits and limitations. Now the last part of this lecture. Can we use WACC as a discount rate when we have to appraise a project, and when we cannot use? See, when you evaluate a project, you need a cost of capital. Why? Because you have to discount. It's like you use it as a discounting factor. Higher the cost of capital means higher the risk of the project. But you need to know that existing WACC can only be used as a discount rate in two conditions. Number one, when the new project has the same level of your business risk. That means business risk is same, asset beta remains same. But what if the business risk changes? Then you need a new WACC. You cannot use the existing WACC. Same way, second is about your financial risk. If a financial risk remains the same, if their gearing ratio is same as your gearing ratio, go ahead and use the same WACC. Otherwise, you need to use the WACC. Most of the time, you cannot use the existing. That's what it is. Now, let us summarize what we have discussed. Isn't this a very easy lecture? It is quite easy. I mean, lots of it are calculations. The time went because we had to calculate a lot of things. Otherwise, this lecture is very much pretty easy, simple to understand, and I personally like this lecture a lot. I mean, this topic a lot. So we started with WACC. Okay, and WACC includes cost of equity, which we calculated three different methods. One is CAPM, where we went through equity beta. To get that equity beta, we went through gearing, re-gearing, right? Get the asset beta, then the equity beta. Then dividend valuation model, where we calculated the growth rate using two models, past and the Gordon's approximation method. Third is Monte-Carlo and Miller's theory, which is used for ungeared and geared cost of equity. Then we went through cost of debt, where we went through redeemable, irredeemable debt. Irredeemable does not have any maturity date. Redeemable, like bonds and all, bond valuation, we have redemption date. And third is credit spread. Table will be given to you. Just put that spread. Add that spread with your risk-free rate and get your cost of debt. Finally, can WACC be used as a discount rate? Only when your business and your financial risk does not change. Otherwise, you need to adjust your WACC. And most of the time, you have to adjust your WACC. Right? So that's it for this lecture. Thank you for watching and see you in the next lecture. And don't forget to subscribe if you haven't subscribed my video and you're watching my video for the first time.